Hello, everyone. This is Justin Smythe from nextbigtrade.com. In the final video for the newsletter this week, I want to discuss corrections in the stock market and how they impact the best stocks. The key thing to understand is that even during these 5 or 10% corrections in the stock market, and when I say the stock market, I'm referring to the S&P 500. Some of the top performing stocks tend to correct much more than that, 20, 30%, even up to 50% during these corrections in the stock market. And that's where you can give back a lot of the gains that you made in the previous rally, unfortunately, because the pressure from the overall market impacts these stocks. And a lot of times, a lot of profit taking takes these stocks down to a much lower level than people anticipate sometimes. So for this example, I want to look at the February to March correction in the stock market, and this is actually turned out to be of 2021. This actually turned out to be the top for many individual growth stocks actually before the bear market in 2022. So this is a little bit more extreme of an example of the give back these stocks can make after they make a top, but I think it's still constructive because the S&P 500 technically only pulled back a little over 5% during this correction, but some of these individual stocks really got hammered. So I think, again, the point is that in terms of position sizing, you want to be position sized larger coming out of a correction and smaller kind of heading into a correction and moving through it. Or you want to be even like very heavily in cash sometimes during these corrections because that's how you get out of them taking minimal damage to your account and you move on to the next cycle more intact versus giving back a lot more because your position size too heavy going into the correction. So putting this in context, heading into February of 2021, the S&P 500 had a very large rally in a lot of individual stocks that kind of started in early November 2020. So it lasted a little over 3 months. And a lot of these stocks had huge gains. So by the time they got to that early 2021 period, they were kind of overdue for a correction. The S&P 500 corrected 5.7% during this pullback. But looking at the first stock, Tesla, Tesla had multiple stage 2 breakouts during its stage 2 uptrend that really started after the COVID panic. And heading into early 2021, it had a major rally where it more than doubled. And then during the 5% correction in the S&P 500, Tesla went from over 300 down to 180. So this was a over 30% correction in Tesla over just, a 4 to 5 week time period. So this is an example of a major leader giving back a huge portion of the gains after this correction in the S&P 500. Next, Celsius was one that broke out in November 2020, right when the market started breaking out. And again, this shows you that when the market came out of a correction in early November 2020, Celsius breaks out into stage 2. This is the best time to get position size large. Is you get a stage 2 breakout right after a correction, and you've got a whole runway of an uptrend ahead of you. That's where the gains were made in Celsius. Then when the market tops, heads into a correction, Celsius gave back over 30% of its previous move as well, corrects back to the 30-week moving average, and then resumes its uptrend after that. So Celsius went on to make higher highs. Tesla went on to make higher highs, but a stock like GRWG actually made its bull market top in this early February 2021 time frame, and GRWG coming out of the November uh, lows of 2020, this stock actually went up a couple 100%, made massive gains, and then pulls back 50% during the February correction in the S&P 500. So a 5% correction in the S&P 500, 50% correction in GRWG. This was a monster winner, gives back tons of its gains, and then has a bounce, but then it resumes stage 3 and then moves into stage 4 later on. So again, this stock, uh, huge winner, but if you're holding it too long into the correction, you're going to give back too much of the profits. Upstart in early 2021, this was an IPO, had a nice run off of its IPO base. The market was doing well. This stock gave back 50% of its value during the February pullback. This one went on to make another major move in 2021, but again, massive losses for anyone holding through that February pullback period. Finally, FTCH, another one that was a big winner out of those November lows and did make its bull market top right when the S&P 500 started correcting as well. Gave back, um, again, over 20% of its value on this pullback. So again, overall, the idea is that it's basically the size of your account. How much exposure do you want to the stock market? Coming out of a correction, when you see new stage 2 breakouts, you want to be more heavily exposed because you've got room in front of you for the stocks to move higher if the market remains in an uptrend. Vice versa, after a long uptrend, when stocks have already ran for a while, the market needs to correct. There's not much runway left. If your position size large, that's where you can get hit more because the stocks that have ran a lot are going to become under selling pressure, and again, they're going to amplify what happens in the S&P 500. So the S&P 500 just corrects 5 to 10%. A lot of these big winning stocks are going to correct much more than that, and that's exactly where you don't want to be in terms of your account exposure to these pullbacks. So hopefully this helps. I'm planning on kind of providing more examples of this on a separate page on the premium website. I think this is important material to kind of understand and learn how to navigate around, because this is a critical, these points in the time or every year, these periods, if you can trade these properly, these really will help you move through the market much easier. And again, you just need to learn how to change your exposure levels is really what it's all about. And I think as a trader, the more experience you get, the more you can develop ways to do this. So